Welcome to Talk Tickers, where we break down the earnings calls that really move the markets. Today, we are diving deep into Alibaba's fiscal Q2 2026 results. And let me tell you, this was a quarter that gave investors some serious whiplash, presenting a real paradox.
All right, let's get right into the numbers. So on the surface, the headline looked pretty good. Revenue came in with a solid 5% year-over-year beat. The stock was actually trading up in the pre-market. But the reality hiding just under the surface was a jaw-dropping 78% collapse in adjusted EBITDA. And once the market really got a look at that number, the stock did a complete 180, closing down over 2%.
So what on earth is behind this huge disconnect? Well, the entire story management told on the earnings call boils down to one simple idea. They are spending aggressively, on purpose, to secure long-term dominance. And that whole story really starts with their absolute powerhouse division, the cloud. Get this. Alibaba's Cloud Intelligence Group saw its revenue growth accelerate to a blistering 34% year-over-year. Now that's not just a little bump. It's a huge signal that the massive amounts of money they're pouring into this space are really starting to pay off and gain serious traction.
And the real engine behind all of this? It's AI. Their AI-related products are now delivered triple-digit growth for the 9th straight quarter. I mean, think about that. That's more than 2 years of just explosive, non-stop demand. And it's not just on the business side. Their new consumer AI app, Quen, had an incredible debut, hitting over 10 million downloads in just its first week.
And you know, this quote from CEO Eddie Wu on the call, it says everything you need to know. He made it crystal clear that this is not a demand problem, it's a supply problem. They literally can't build their AI data centers fast enough to keep up with customer orders. That just shows you how white-hot the demand for their infrastructure really is.
Okay, so the growth is amazing, but it comes at a truly staggering cost. So let's flip over to the other side of the balance sheet and look at what's become the market's #1 concern, the cash burn.
The company burned through 21.8 billion RMB in free cash flow this quarter alone. This is a massive reversal from having a net inflow of cash just 1 year ago, and honestly, this number right here is the single biggest reason investors slammed the sell button.
In this chart, it shows you exactly where all that cash is going. Look at the revenue from their quick commerce business. We're talking instant delivery. It surged an incredible 60%. But to get that growth, they had to spend heavily on subsidies and logistics. And that spending is what directly led to that 78% cratering in adjusted EBITDA.
So this all leads to the $1 million or maybe $1 billion question that every Alibaba investor is asking right now. With such intense, cutthroat competition from rivals like JD.com and Meituan, what's the actual path to making a profit on these massive, massive investments?
Well, management's answer is basically, trust the process. They're arguing this isn't a panic move. It's a deliberate, multi-year strategic bet. And to their credit, they laid out a pretty clear, phased approach on the call to justify all this short-term pain for what they see as long-term gain.
For quick commerce, their roadmap is a classic 3-step plan. Step 1, which they say is now basically done, was all about grabbing market share and growing sales volume. Now they're in Step 2, making every order more efficient. And the final goal, Step 3, is to actually drive sustainable profits, with a huge target of 1 trillion RMB in sales within 3 years.
Now, you heard management use this term unit economics a lot on the call. All that really means is making each individual delivery less unprofitable. And they threw out a really key piece of data to prove their plan is working. They said the loss on each order has already been cut in half since the middle of last year.
But when you look at the AI side, the spending gets even crazier. They've publicly committed to over 380 billion RMB in capital spending. But then, during the Q&A, they hinted that, given the insane demand we just talked about, that number might actually be, quote, on the small side. They are going all in. No question about it.
All right, so you've got this spectacular growth on one hand and this frankly terrifying cash burn on the other. So where does that leave Alibaba? Here is our take on the path forward and what we'll be watching for on the next earnings call.
For next quarter, we're expecting continued solid revenue growth, probably in that low to mid-teens range. But for the stock price, we think it's likely to stay volatile and stuck in a range. The market is basically caught in this giant tug of war between the bulls, who see the long-term AI story, and the bears, who can't get past the near-term cash burn.
So, when you put it all together, here's our official call. We are initiating coverage with a market perform rating. Look, the long-term potential in AI and cloud is absolutely undeniable. It's exciting stuff, but the short-term uncertainty around profits and the massive execution risk in this spending plan are just too big to ignore at its current price.
This is not financial advice.